that and really looking forward to that meeting. It's going to be dramatic. Thank you. Will OPEC actually cut oil production next week? Let's ask Chad Brownstein from Rocky Mountain Resources and Peter Amandio from Chicago Energies. Welcome to you both. Chad, do you expect cuts at next week's meeting?
I'll tell you why they won't cut it. They won't cut it because they have the issue of the Sunni versus Shiite, Iran versus Saudi issue. But they shouldn't cut it because they have U.S. markets on their heels right now. You're going to see our rig counts go down. The corporate boardrooms in America are stagnant, not knowing where oil is going to go. So they're not going to cut it. There's a reason why they shouldn't, and there's a reason why they won't.
Peter, what do you got on the floor? Will they or won't they?
Well, all along, they've been talking about lower prices, and I would assume that they were talking about lower prices so they could get rid of their competition, such as North American shale and Canadian producers, where their cost is a lot higher. So they want to get rid of this high-cost production that is their competition in the market. So
you don't think they're cut either?
I don't really think there's going to be a cut. I think they want to see lower prices to get their competition out of the market.
And if there's an announcement, Peter, next week that they don't cut, what do you think the price of oil does?
I would imagine that it would fall a couple dollars. One of the things we were seeing here today is option premiums were very soft, which are insurance, in the very beginning of the day. As we got near the close, all of a sudden puts, which are the right to get short, got very high, which is telling me that they're already fearful of a gap open lower on bearish news from OPEC.
You know, this is fascinating, Chad. It maybe goes to show how soft the oil market is right now. How much further do you think the price of oil could fall in the months ahead?
Well, as I said on your show last time, 77's the new 100. You have an issue right now where the Iranians are partnering with the Russians against the Saudis. You have OPEC, who's been delivering 8 million barrels to the U.S. historically, now is doing 3. They're not cutting production. They're going to hope the U.S. sits on their rigs. The U.S. is going to come down from 1,900 rigs at these prices. They're going to be flowing their oil at 75 to 78, and they're going to be in very good shape with the U.S. a bit stagnant over the next 2 quarters.
And Chad, talk more about what that impact will be on the booming shale industry here in the United States and up in Canada. They're going to have to deal with lower prices because their cost of production is so high relative to those prices right now. Do we see consolidation in the industry, or what do you think will happen?
You're going to see a big M&A strategy in 2015. You're going to see a rig count down 10 to 15%. The corporate boards in America can't possibly allocate costs to drilling when they don't know where the prices are going to be in 3 quarters. So if they're doing that at the beginning of the year, you're going to see corporate boards not outlaying capital. You're going to see mergers having to take place, and there'll be consolidation. There still will be meaningful production, but it's certainly not going to be at the rate it was in 2014.
Right.
Yeah, it seems like that's what's happening anyway, Peter. So I guess just a final question is, how much does this OPEC meeting and OPEC itself matter to the course of oil prices and oil production in this country in the months ahead?
I think it means a lot, but if you were looking at the different producers, I think what you really have to look at by the companies is who's hedging, who protected themselves, who protected their shareholders.
Well, interestingly, Continental said that they're not going to hedge now at these prices, so it's going to be a fascinating week next week.
Yes, it will be. Good stuff. Hey, guys, thank you. Appreciate it. Chad Brownstein, Peter Amandio, thanks for joining us today.
Thank you.
Appreciate it. 30 minutes.